So chapter 2 is another introductory chapter. We can see it's going to give us the building blocks of managerial accounting. So we're going to get some definitional type things, and we're also going to review the income statement that we learned back in financial accounting, and then take it a step further and look at how it's different when it's a manufacturing company. So we know kind of basic 3 types of companies in financial accounting. We started off talking about a service business. Then we worked on merchandisers. And in this class, we're going to talk about manufacturers. So again, kind of obvious. We know a service company provides a service. It doesn't have any inventory. So an example would be, say, H&R Block, who, prepares tax returns for folks. Merchandising company would be any retailer, right? Walmart, Target, Walgreens. Buy product from a supplier at one price, mark it up, sell it at a higher price to their customers. And so a merchandising company, we learned, had an account called merchandise inventory. Now we're going to be looking at manufacturing companies. So a company that makes a product and then sells it to customers. So usually the first one that comes to mind would be, say, Ford or GM, right? They're making cars and then selling them to customers. And so back in financial accounting, when we learned about merchandise inventory, we knew that that was a current asset on the balance sheet. A manufacturing company is going to actually have 3 inventory accounts that they report on their balance sheet. Their raw materials inventory, their work in process inventory, and their finished goods inventory. And so we can kind of see how the costs are going to move through the 3 inventory accounts. So we buy the raw materials, the things that we need to make our product. And so when we buy those materials, they're in the raw materials inventory account. And then when we start working on making the inventory, the costs are going to move out of the raw materials inventory account and into the work in process inventory account. And then when the product is completed, it will move out of the work in process inventory account and into the finished goods inventory account. And it'll sit there in the finished goods inventory account until we sell it to our customer. And when the product is sold to the customer, then the costs move out of the finished goods inventory account into the cost of goods sold account that is shown on the income statement. Now, another concept that gets introduced in this chapter is the value chain. All of the activities that add value to the products. Okay, so we incur costs, but if they add value to the products, then we can pass that cost along to our customers, right? And so we want to minimize our non-value added costs. So things like inspections, testing, those are costs that you have to incur, and they're important, but those don't add value to the product. It's just making sure that we don't sell a defective product to our customers. Things like research and development. That's how we learn about innovating new products, adding features to products, designing the product, and then either production, making the product, or purchasing the product. So if we're going to be a merchandiser, they would have purchasing as opposed to production. Then marketing the product to the customers, distributing, and customer service. The cost object, anything for which you're tracking the cost. So you could be tracking costs for a specific units of production. You could be tracking the cost for a marketing strategy, right? And so we're looking at 2 different marketing strategies. So looking at the cost of the 2 different ones to decide which marketing strategy you want to choose. We may be tracking costs for a segment of the business, right? So the Midwest segment of the business versus the East segment of the business, or a specific department. And when it comes to cost objects, we can break the cost down to either a direct cost or an indirect cost. So if we can trace the cost directly to the object, right, that's a direct cost. If it's a cost that needs to be incurred but you can't directly trace it to the project. You call it an indirect cost. So when we're talking about production, anything having to do with the plant where the product is being made, that is a cost of the units that you're producing. Now, some of the costs you can directly trace to the project. So the materials, the raw materials that you're actually using for the project, okay, you know how much they cost. You can see the quantity of materials you use for the project. So that's a direct cost, those direct materials that you're using to make the project. Then you could have indirect costs would be another example of a direct cost would be direct labor. So how much time the person spent making the product and what's their hourly rate. You can figure out how much it cost in labor to make that product. But then there's other things having to do with the plant that are costs that are necessary for you to make the product, such as the property taxes for the plant, the utilities for the plant, the depreciation on the plant, the depreciation on the equipment, right? All those costs need to be incurred, but that you can't trace that to one specific unit that you're making, right? Those costs are being incurred for all of the units that you're making. The plant manager's salary, that's a cost that's being incurred so that you can make all of the products in that plant. Those are considered indirect costs. So let's take a look at some examples here. So this is the junior department at a Kohl's location. And we're going to say if this is a direct or an indirect cost. So the depreciation on the building, right? So the depreciation on the building, that's for all of the departments in the Kohl's. So that's going to be an indirect cost. Okay? It can't be just directly traced to the junior department. How about the cost of the costume jewelry on the mannequins in the juniors department? Okay, so that would be a direct cost that's being incurred only for the juniors department. The cost of the bags used to package customer purchases at the main registers for the store, right? That would be an indirect cost, because when customers go to the cash register at Kohl's, they can have items from all the departments, not just the juniors department. So the cost of the bags are being incurred for all departments. That's an indirect cost. The Kohl's store manager salary, that would be an indirect cost. It doesn't just benefit the juniors department, it's the entire store. The cost of the security staff at this Medina store would be an indirect cost. The manager of the juniors department, that would be a direct cost. That cost is being incurred solely for the junior department. The junior department sales clerks, that would be a direct cost as well. The cost of the juniors' clothing, that would be a direct cost. That pertains just to the department itself. The cost of the hangers used to display the clothing in the store, that would be an indirect cost, because some of those hangers are used for juniors, some are used for women's, some are used for men's. Okay. The electricity for the building, that would be an indirect cost. It benefits the entire store. Cost of radio advertising for the store, that would be an indirect cost. It benefits the whole store. The junior clothing buyers' salaries. So these would be the buyers in the corporate department. So the corporate headquarters for Kohl's is in Wisconsin, and there's somebody there that does the purchasing for all of the juniors' clothing that goes out to all of the Kohl's locations around the U.S. Some of those clothes that the buyer picks out are going to be for this Medina location. So that's going to be an indirect cost of the juniors department of the Medina store. So that's the differential between direct costs and indirect costs. Another thing we want to distinguish is product costs and period costs. So a product cost is anything having to do with manufacturing. So any of our product costs would be our direct costs, our direct materials, our direct labor, and then our indirect costs would be what we call our manufacturing overhead. So these are all the things that are being incurred to make the product. Okay? And so we talked about, we have raw materials inventory, we have work in process inventory, we have finished goods inventory. Those are being shown on the balance sheet. So if we can see our balance sheet here under current assets, right, we start off with cash, we've got accounts receivable, and then we would show our inventory accounts. These are where we record our product costs. And the costs move from raw materials to work in process inventory, and then any of the direct labor and the manufacturing overhead, the indirect costs having to do with the product, are in work in process inventory. And then those costs move to finished goods inventory. When the finished goods are sold, then those costs move to the cost of goods sold on the income statement. Okay? And so that's what our product costs are. And so if you're a merchandiser, you've got the purchase price of what you paid for the inventory. We talked about that back in financial accounting. We also talked about freight in, the freight charges you had to incur to get the goods shipped to you when you were buying them from your supplier. We didn't talk about, but if you're buying it from a foreign country, you could have import duties or tariffs. Those all become part of the cost of the product. For a manufacturer, as I said, we've got direct materials and direct labor. Those are your direct costs. Manufacturing overhead is your indirect costs. So your indirect costs could be indirect materials. So indirect materials would be materials that you can't trace to a specific product. So for example, glue, right? You might just have a big vat of glue, you grab some glue, and you're working on all different products out of that glue. Since it's a small amount, we don't trace it directly to the product. It could be sandpaper. If you're building, wood chairs, right? And so you have a piece of sandpaper, you use it on a few different chairs before you have to go get a new one. That would be indirect materials. Indirect labor would be things like your plant manager's salary. The manager of the plant is overseeing all of the products being built, not just a specific one. It could be the janitor for the plant, right? Those costs aren't being incurred. You can't trace it to a specific product, but you need the janitor cleaning the plant or we can't make the product. Okay. And then other indirect manufacturing costs. So that would be things like the utilities on the plant, the property taxes, depreciation on the plant, and the equipment. So those are all costs that are being incurred as part of the manufacturing process, but you can't trace them to a specific product. Your period costs are all the costs that are not product costs. So back in financial accounting, when we were talking about a merchandiser, okay, the merchandiser, as we said, they would just have the cost of the purchasing the product itself, but then all the rest of the costs were selling expenses and general and administrative expenses. Those were the operating expenses on the income statement. So if we look at our income statement here, right, sales revenue minus cost of goods sold got us to gross profit, and then these operating expenses, these are our period costs. Right? So it would be things like your salespeople's salaries, your advertising, those would be your selling expenses. Your general and administrative expenses were your office type expenses, right? So your office worker's salary, depreciation on your office equipment, right? All of those things are the period costs. So that's what the difference is between period and product. A period cost is going to be deducted immediately on the income statement. Product costs become part of inventory initially.